how we see things moving forward. We expect the curve to smooth out through May of 2022.
For the introduction, Roger. I'll be doing a quick overview of the commodity run-up especially for natural gas prices and for power prices. I'd like to answer questions as where we are in terms of pricing, how we got here, and the implications moving forward into 2022, and the ripple effect into power generators and utilities in Europe. So first of all, if you could just switch to the next slide, please. Roger, yeah, there we go. Okay, great. So this chart shows us the run-up in natural gas prices. The TTF benchmark in the Netherlands shows a extreme price surge, especially in September. And why is this important to power prices? Because natural gas prices are price setting amongst wholesale markets in Europe. And this is why the two lines, the blue line and the white line, are closely correlated. So why are natural gas prices high in the UK and Europe? Basically, natural gas prices have quadrupled since January, reaching an unprecedented all-time high of $84 per megawatt as per this time of day. This equates to about $180 of barrel equivalent, if you'd like to have that comparison versus oil. So why? There's mostly supply-driven factors, but we should touch upon demand side as well. So climate factors have been important in the run-up in demand. For example, summer heat waves in Asia have caused LNG demand in Asia to capture LNG exports, as well as a drought in Brazil, reducing the hydro output, have also sort of drawn LNG cargoes that way, and lower renewable electricity output in Europe have contributed. All these, along with post-pandemic demand recovery in the economy, have caused sort of this strong jolt in demand. On the supply side, storage European levels are atypically low. These remain below the 10-year norm, and this is due to many factors. This is a combination of outages in Norway. This is also due to lower flows from Russia, and again, a persisting tightness in the LNG markets. Could we just move to the next slide, please? So moving on to the pricing itself and the backwardation of the forward crude curve for pricing. You can see this chart. What it shows us is what the spot prices on the left are, like the forward pricing for through December through all the way to 2025 on the right. If anything, you can see that the surge in prices was unexpected by the market completely. As you can see, the green line is the 3-month forward curve prior to this date, and we've seen an immense pressure upwards. In terms of how we see things moving forward, we expect the curve to smooth out through May of 2022, and this is sort of in line with market expectations, and this is mainly due to the lower seasonal demand after winter. The curve implies that these prices may ease, but we don't discount more volatility given the market tightness and the uncertainty over winter. Again, we believe that the main catalyst will be the temperatures during winter this year and all the ripple effects that this will have both on the LNG markets globally and also in Europe. Could we move towards the next slide, please? Right. So the low gas storage levels in Europe are the main supporting factor behind the elevated prices in natural gas. And what we can see here is that we are about 72% full in Europe, and this is versus a 5-year average of about 90%. This increasingly suggests that we're going to enter winter with abnormally low storage levels. What are the main catalysts or things to see? The pace of refill mainly hinges on more output flexibility from Norway, so we can see a bit more flows from there. We see limited upside flows from Russia, as Russia is also struggling to refill its own inventories. Although there's a bit of a speculation over any political motivations behind Gazprom not increasing flows, we actually see that they are having trouble replenishing their own inventories for winter. And finally, LNG. LNG could be a factor that could sort of ease supply pain, but we still see demand in Asia remaining strong through the winter. We go to the next slide, please. Again, hitting again on LNG supply. On the chart on the right shows us the level of competition that there is for spot LNG cargoes in Asia. So as a context, most of the LNG imports in Asia are linked to oil prices, and about 60 to 65% of the imports there are linked to oil prices. So Asian off-takers are maxing out their long-term contracts, trying to lure in demand before the winter, and this has kept the differential very high between Henry Hub and JKM, which is the Asian benchmark, basically drawing away cargoes from Europe into Asia. We don't see this easing substantially into the winter. So if anything, we expect a little help from LNG, but it may hardly move the needle in terms of storage capacity. Next slide, please. Finally, gas supply, which is the main source of gas in Europe, especially from Russia. Russia accounts for about 40% of the imports in Europe, followed by Norway. Again, we have to reiterate, the nearest term catalyst for pipe flows will be Norway, which has announced that it can expand capacity by about 1 BCM through year end. So there's some support there, but there's a bit more of uncertainty over Russia. Commissioning of the Nord Stream 2 pipeline could be a major catalyst, though we don't see that happening this year, as it's likely that the startup of this pipeline will be moved into next year, especially given it requires regulatory approvals that are set to take place in Germany. And Germany is also going through sort of a political shift at the moment. In terms, again, of LNG supports about 20% of consumption in Europe, but that's set to remain tight into next year. Next slide, please. And just hitting home on the message about our view on natural gas. We expect prices to remain elevated through the winter, although these sort of record high levels we deem them as unsustainable, just because they may start to create demand destruction and sort of rationing of energy, as we've started to see for some industrial consumers. How do we see demand playing out? We see a post-pandemic recovery sort of driving steady increase in demand, but the main driver for the storage levels and sort of the overall volatility of prices moving into the winter will be if we have a mild or cold winter. A cold winter would mean that we would be close to depleting all of the storage in Europe, according to our analysis of historical levels, and a mild winter could mean that we actually could replenish most of the storage levels through the summer of next year, and that sort of has a negative implication for price. Also, high renewable output, as the wind has not been blowing, as pointing something that everyone has been saying lately. But yes, renewable output has been lower than the 10-year average, especially in the UK and Europe. So this can be another contributor. Then finally, on the carbon pricing, we see that as a sustained fundamental midterm for gas demand, as coal to gas switching is set to continue, as we aim to decarbonize generation in Europe, whilst renewable capacity continues to ramp up. On the side of, sorry, yeah, that's fine. Thanks, Roger. Finally, the potential winners and losers from the price volatility, and this is focused solely on utilities. So we see unhedged generators with exposure to marginal cost generation, such as hydro and nuclear, as the best place to benefit from the volatility at the moment. As the only thing that we must note is that most of the generation for 2021 has already been sold forward at fixed prices, about 90% across utilities. But we do see an opportunity for a lot of them to replace their 2022 and 2023 hedge books with higher fixed prices. In terms of suppliers, Integrated utilities and large suppliers are poised to gain market share on the back of the pain of the smaller retailers, which are a bit more exposed to wholesale pricing. Next slide, please. Finally, this is just a final overview of how the natural gas prices affect utilities and how the power prices affect utilities. Again, natural gas prices will have an outsized impact for utilities with exposure to upstream and, of course, gas suppliers such as Gazprom and other upstream focused players. Energy suppliers that rely on wholesale markets may be in trouble, as we've seen in the UK. Just since the beginning of August, we've seen 7 smaller retailers go out of business, and we see a number of them could still be on the way to that. Larger suppliers and integrated utilities can afford the financial burden of taking on these customers, although these will not be very profitable in the beginning. We see this as a potential catalyst in the future just to expand market share, which could be especially good for someone like Centrica, which manages British Gas, and sort of cause an inflection in market share there for them. For power prices, again, unhedged generators with hydro and nuclear exposure are poised to gain. 2 names that are important here is the EDF and ENGIE, which have sizable generation capacity in hydro and nuclear, although their sort of upside risk there is capped by the amount of regulated volume at fixed price that they have to sell, which is about 25% of their capacity every year. We see more upside for high power prices in 2022 and 2023, and we see a neutral impact in the short term for renewable operators such as SSE and RWE, as most of the renewable energy is already at fixed cost on their long-term contracts. And again, we don't foresee regulatory risk at this moment, except for Spain, which has already declared it will have a windfall tax for windfall profits, as Spanish utilities are poised to gain from the surge in gas. So we don't expect more regulatory risk on other nations that have already announced that they will take fiscal measures to soften the burden on consumers. And that's all for me.
All right. Hi, everyone. This is Rob Barnett. I'm up next, and I want to build from the comments that my colleague Patricio just offered. So an important layer, as Patricio and Roger already hinted, for the European energy landscape is Europe's carbon pricing mechanism. And so if you're not super familiar with this component of the market, this is not an ESG-driven voluntary kind of approach to carbon. We're talking about the mandatory cap and trade program that's been in place for a number of years here in Europe. And the basic function is that the government sets a cap or a supply of credits on carbon emissions, and the industry sets demand, and the market determines the price. And as Patricia already hinted, we see a structural rise in that price going forward. So Roger, if you could just go to the next slide. On this slide, you're going to see the dramatic increase we've seen over the last 12 months in the carbon commodity price, almost up twofold this year. It's one of the best performing commodities. It just hit a record 65 euros a ton this morning, and regularly we're setting new records for the price run-up. By the way, if you were to zoom back about to the start of, let's say, 2017, this commodity was trading for about 5 euros a ton. So we've seen a 12x rise over the last few years, and just it really stunts what we're seeing in other commodities. And there are reasons why the prices run up. The main one is that the government, the European Commission, has set stricter limits on the amount of carbon that they want to allow in the atmosphere in the future. So they've essentially from a supply-demand perspective, they've restricted the supply of credits when you look out into the future. And if you look at our colleagues at Bloomberg NEF or the International Energy Agency and the kinds of carbon price that would be needed to hit that, the cap on emissions or the reduced supply, they're talking about €100 pricing sometime by around 2030. So there could be continued upward momentum as long as the government sticks to its guns and really does move forward with some of these aggressive reductions in carbon emissions. Roger, if we could go to the next slide. Now, one thing I want to make sure I hit home here is that carbon pricing doesn't happen in a vacuum. It's got all sorts of feedback between what's happening in the power market, and there's a lot of read across into companies. So the CO2 price, what I'm showing on the screen, if you don't know it, there's a function called HRA. It's basically how you run a regression on the terminal. And the carbon price and power prices in Europe are very correlated. The German power price and the carbon price are about 70% adjusted R squared. And if the commodity for carbon moves higher, it really does flow through into all sorts of industries. And if we could go to the next slide, I just want to give you a flavor of kind of how to think about this from a company perspective. Because as we all know, the rising carbon price, certainly if you hold those credits, maybe it's a good thing, but if you're a company, this is really potentially hitting you on the cost side of the equation. So on the utility side, RWE has the biggest emissions footprint, but you all see companies like Enel, Uniper, Engie there. Refiners are subject to the cap and trade program. So when you drive your car in Europe, you don't pay at the retail pump, but for all the emissions that occur at a refinery, these are subject to the cap and trade program. So big emitters there would include Total, ExxonMobil, Repsol, and on down the list. Roger, next slide, please. Just to give you a couple other sort of names or sort of sense of who's affected by this. On the steel producers are also subject to the program. So our colleague Grant's going to talk a little bit later on kind of metals and mining and inflation there, but the steel producers, ArcelorMittal, Tata, Voestalpine, are seeing potentially higher costs because of this run-up on the carbon side. Airlines here in Europe are also part of the program. So a whole set of industries really could be impacted. If we could go to the next slide, I'll give you sort of a sense just with an anecdote here. So let's look at the refining sector. So what you're looking at here on the screen is, well, what's the cost to refiners in Europe at different levels of carbon pricing? And there's a couple of things you have to take into account. So some of the industry received credits for free based on their historical emissions. And so they don't have to go out and buy a full ton for every amount of carbon they put in the atmosphere. They just have to sort of incrementally buy what they didn't get for free. And so if you think about the current carbon price north of 60, you're adding 45, 50 cents a barrel to the cost basis for refiners. But for the marginal refiner who, let's say, didn't get any allowances for free, maybe a new refinery or they've expanded, you're talking about a price cost closer to $2 a barrel. So this is these are non-trivial numbers. My colleague Sally Ilmaz is coming on next, and he covers the refiners. But we're talking about potentially hitting margin by something like 25%, and we're still in a relatively nascent recovery for the refining segment following a pretty tough 2020. If we could go to the next slide. Couple last comments from me. One is that the whole point of the carbon market is to change behavior. So increasingly, we might see industries thinking about, well, what can we do to reduce emissions? You certainly in the short run have coal to gas switching, but eventually we might see something like green steel made using hydrogen as opposed to the traditional methods. And Grant can speak more to it, but there's some potential that could happen. Our colleagues at Bloomberg NEF say you could make steel using hydrogen for as low as about $70 per ton carbon, which we're within spitting difference of today. And so it'll be very interesting to see whether we start to see more investment on that side where you permanently reduce emissions. And then the last piece of this is that this is not only a cost impact story or an industry affected story. Roger, if we could go to the final slide for me. I would note that because of the big run up in carbon prices, we're seeing all kinds of interest in the commodity generally. And so if you look, there's a function called FFLO on the terminal, which allows you to see fund flow into various thematic funds. And so we've actually seen an outflow into most energy commodity related funds over since the start of this year. But the carbon related funds tend to be doing quite well. I highlighted Crane Shares, KRBN fund, but there's quite a few of them at this point. And so a lot of investors have taken exposure to this market. And the one thing that I would highlight on that front is there are some serious considerations in the European Commission to limit the role of speculators. And so how that would actually look, we don't know. But if you are thinking about the carbon market, European regulators seem to want high carbon prices, but they don't necessarily want folks to make much money off of it. So let's see how that unfolds, and I'm going to hand it over to my colleague. I believe Salih Ilmaz is up next to talk us through his view on the recent run-up in oil prices.
Thank you very much, Rob. So my name is Salih Ilmaz. I am one of the oil analysts for Bloomberg Intelligence here in London. And I want to spend a little bit of time talking about crude oil market outlook that we have. And it's not quite like gas that's been talked about in the first half of the webinar, but we are now seeing a significant momentum building for crude prices. We saw this morning Brent hitting $80 a barrel. That's the highest level since 2018. But before we talk about crude, I do want to spend just a minute talking about the UK fuel shortages that we're seeing at the moment, because I think it's just very interesting. And I mean, as you may have heard, a lot of stations in the UK are now running dry after a weekend of panic buying. And BP, which is the largest network operator in the UK, said about a third of its branded stations ran out of the main grades of fuel on Sunday. So, I mean, I live in the UK. I only have about half a tank full at the moment, so I'm not sure what I'm going to have to do, but I'm hoping that this will be over. But in a recent report that we published yesterday, we are arguing that it will be over soon because this is actually a logistics issue rather than a supply issue. The UK has 6 refineries, 47 oil terminals, which are all operational. So I think the fizzling out of this panic buying and these demand patterns that we saw over the weekend and the first part of this week. And I mean, we saw the government suspending the competition rules and potentially involving the army to drive and deliver fuels, I think will help kind of ease this crisis. Anyway, if you can go on to the next slide, on to crude, which I want to spend more time talking about. So as I mentioned, momentum is building for crude prices as well, and there are a number of catalysts driving the surge. And I will go through some of them, but overall, the message is that there are a lot of upside drivers at the moment, but at the end of the day, there is significant supply that is sidelined at the moment, and OPEC is still on the driver's seat. So, and the group is still meeting every month, which would allow them to intervene and bring back more supply if they need to, and if prices go to very high levels where some of the larger customers start complaining. So we might see prices rising in the very near term, but supply is there to respond relatively quickly to see prices normalize. So if you can go on to the next slide. Once again, this morning, you may have seen Brent prices hit $80 a barrel, highest level since almost 3 years. And I think some of the main drivers are, I mean, the most interesting one, I think, is the gas to oil switching that that we are potentially going to see more of amid this gas price surge. And along with that, much better refining margins compared to the first half of the year, and air travel easing are all supportive for oil prices, and I think are all adding to this positive sentiment that we're seeing for crude prices. If we can go on to the next slide, please. When we look at the rest of this year, it is a tight market and a tightening market. Demand is rising, supply is constrained, and when we look at the third and fourth quarter, we are looking at a tightening market. In terms of supply, we also note that some member nations within OPEC, such as Nigeria, Angola, and arguably Russia, are struggling to boost their output in line with rising production targets. So the actual output hike that we see in the next couple of months may not quite be exactly the number that we are expecting, the 400,000 barrels a day that OPEC is aiming to bring back. So if you can go on to the next slide. And supply is constrained, and that's because OPEC Plus it has been quite cautious about bringing back supply. The current policy, as mentioned, is 400,000 barrels per day per month, which has been working quite well, kind of keeping prices range bound between $70 to $75 a barrel. But looking at the rest of this year, this is starting to look a little bit on the conservative side. And given the extra addition to oil demand that we're seeing, again, from higher refinery runs, from more air mobility, adding to jet fuel demand. So this is obviously going into the next OPEC meeting, which is next Monday, October 4th. We will be watching the tone and the language that the group gives us at the next meeting, because if oil prices keep rising, we will most likely see increasing pressure on the group from large consumers such as India, China, and potentially the White House, pressuring them to increase supply perhaps more quickly. On to the next slide, please. So what's also giving a boost to demand, as mentioned, in the next couple of months can be this potential gas to oil switching for power generation by consumers, and that's estimated by many to be around 500,000 barrels per day. But we did see some estimates that are as much as 1 million barrels per day. But either way, this is a significant and meaningful amount of additional demand that we may have foreseen initially. So we will be watching very closely what OPEC comments on this as well. And the next slide, please. Looking at inventories, I think OPEC Plus has done a very good job of depleting inventories from historically high numbers. They are now at, when we look at commercial crude and product inventories, they are now well below 5-year average and very close to 10-year average as well. So low inventories combined with all these drivers that we talked about, I think are really setting up the stage for strong oil pricing in the near term without any additional OPEC intervention. If you go on to the next slide, please. But again, we need to remember that there is still plenty of supply that OPEC and OPEC Plus is keeping off the market. And on top of that, on the supply side of the equation, we shouldn't forget about Iran, because there is the potential return of Iran if there is a deal reached between the US and Iran and a nuclear deal. And in the case of a deal, Iran could bring up to 1.3 million barrels per day of oil back into the market, which is very significant. As things stand, it doesn't look like there will be a deal this year, but we can't rule out the potential of a deal perhaps early next year. So there is this additional supply that may reemerge at some point, potentially in early next year, that we shouldn't forget about. And on the next slide, please. Beyond the rest of this year, which is what we're focused on at the moment, some downside risks are there for oil. Namely demand weakness. We are seeing good recovery in demand, but we could see a slowdown in that recovery in early next year. We could see lower compliance by OPEC Plus. We should say in the last year and a half, we have seen very good compliance as a group. But that could be a lot less for the rest of this year or early next year. We could see appreciating dollar, and we could see new COVID variants. But on the next slide, please. Again, we look at beyond the rest of this year, we see the market potentially flipping into surplus again. So slowdown in demand recovery and all that additional barrels of oil brought back by OPEC, which may not be enough for the rest of this year, and we will be watching what they do in the next few months. When we look at 2022, we are seeing the market potentially turning into a surplus. So that will be interesting to see. So again, beyond the next few months, we may see prices kind of normalizing, and until then, OPEC is meeting every month. So if prices do get too hot, too high, and get in that kind of demand destruction zone, as Patricio mentioned, I think we will see more pressure on OPEC, and we could see kind of an adjustment to their policy before too long if we do get oil prices running closer to $90 a barrel or $100 a barrel. So that's it from me. Thank you very much, and I will hand it over to my colleague Will Harris next.
Hi, thank you very much, Sally and Roger. My name is Will Harris, and I'm one of BI's senior analysts here in energy in London. If we could just move to the first slide, please, Roger. So as Sally mentioned, Brent oil has climbed above $80 per barrel just this morning, and so I think a good place to start off is just to take a look at the relationship between oil prices and inflation. They are clearly positively correlated, as you can see from the chart there. This is primarily driven by oil's key role as a global economic input. And so with the significantly tightening oil market over the next 6 to 12 months, as demand is recovering from COVID and alongside widespread underinvestment in oil production and the potential gas to oil switching that Sally mentioned earlier this winter, really underscores risks to the upside on oil prices near term, and also sort of underpins our view that global inflationary pressures are unlikely to be transitory. Can you move to the next slide, please, Roger? And so we've seen a wide disparity in share performances between the oil subsectors throughout the pandemic, and we think this really reflects the uneven effect that this inflationary environment can have. So you can see that global oil and gas servicers have actually stood out here. Now, I think it's important to note here that they actually suffered among the worst in response to the pandemic, but have really since benefited from increased visibility for investment, for more tendering opportunities, and also the ability to pass on the inflationary effects and higher input costs onto clients in order to defend their margins. And so for the E&P space, we expect cost and capital discipline to endure here. We're seeing recovering free cash generation already, and we think this will manifest in an increased amount of share buybacks or potentially dividends for some, maybe a little bit of M&A activity as well. But we highlight here that the poor performance among the E&Ps has really been driven by a select few names which struggled with indebtedness. On the oil major side, they're also improving as well, but their response to an inflationary environment will be more moderated in our view. This is given their balanced production mix, downstream exposure, energy transition expansion, and generally lower gearing. Can you move to the next slide, please, Roger? And so we've developed a heat map here for our view on European oil majors and our core European independent E&Ps for their exposure to oil price upside based on 4 factors. And so we highlight that those with pure play upstream exposure are best positioned, and particularly those with high oil weightings, low operating costs, production scale, and low carbon intensity, alongside some material net debt on the balance sheet. This makes these companies highly levered to the oil price upside. So for the oil majors, we see Equinor and Total as the most exposed, and for the E&Ps, Lundin and Aker BP, these are the Norwegian operators. They have very, very low costs, low carbon, significant scale. Next slide, please, Roger. And so on the cost side, I thought I would just highlight this quite quickly. We see limited impact for these sectors, which are seeing only modest cost inflation in areas like steel and logistics. This is really because they're sheltered by the stabilizing effect of long-term contracts, which are standard in the industry. And so we think this positions them well amid the continued recovery in global oil demand. And as Pat detailed earlier, soaring gas benchmarks, particularly in Europe, and constructive movements on oil prices here. So they're really benefiting from the upside and protected from any cost inflation as well, mostly. Next slide, please, Roger. So I think this is a key element to point out here that European oil majors have cut their spending dramatically in recent years, which along with the reallocation of their capital priorities, namely through diversification into energy transition businesses, is likely going to and already is arguably filtering down into supply risk. So this group has cut capex by roughly a third from pre-pandemic levels, and nearly in half from the boom years in say 2014 and before. And this has been mostly targeted at the early stage discretionary projects, so frontier exploration, and then flexible short cycle investments. So the obviously one that stands out is the U.S. Permian have been the key areas for spending cuts. But also, most of these companies are beginning to de-emphasize oil production growth. They're also divesting legacy oil assets. We've seen this recently with big deals by Shell and BP. Shell just sold their entire Permian portfolio to ConocoPhillips for $9.5 billion. And so both of these companies have already noted that they have reached peak production, while Total, Equinor, and Eni will begin to decline their production from mid-decade. And so we believe that this is a key factor in contributing to weak non-OPEC supply growth this decade. If you can move to the next slide, please, Roger. And so I suggest, I mentioned this earlier, but we're also seeing the early stages of portfolio rationalization, driven primarily by the energy transition for this group. And it's important here to understand that 90% or more, excuse me, of this group's CO2 emissions, including scope 3, originate from the combustion of their refined oil and gas products by consumers. And so this makes the provision of lower carbon energy products an absolutely crucial lever for these companies to reduce their emissions over the long term. Effectively, they need to produce less oil, more gas, and more electrons over the long term. Natural gas here has relatively lower CO2 to energy content compared to other fossil fuels, roughly about a third lower than gasoline and diesel. So it's obviously a more complementary area for them to target to reduce emissions. And so most of these companies have been investing heavily in gas and LNG exposure. And so we anticipate a continuing evolution in the upstream average production mix from the European majors to a majority, so at least over 50%. I think we could be a bit conservative on this as well, from about mid 40% currently. Next slide, please, Roger. And so on top of the change in production mix, we're also seeing ambitious renewable capacity targets and quickly rising transition spending for the European energy majors. And we think this really reflects an acknowledgement of the risks to long-term oil demand from a few areas. So this is from internal combustion engine efficiency gains. It's from the proliferation of plug-in vehicles, and more broadly, just the general electrification of the global energy system. So we expect at least half of European major capital budgets to be deployed into what we call transition businesses or green businesses by 2030, from roughly 15% currently. And this is driving a major expansion in power generation, in renewable power generation, to utility level scale, as you can see there in the left chart. However, this is a historically narrow margin business, particularly when you compare it to oil and gas, and may represent a longer term risk to profitability for these companies. If you can move to the next slide, please, Roger. So we are seeing the energy transition manifest in significantly widening strategies among the global oil majors, and it's most pronounced between the Europeans and the Americans. Exxon and Chevron are doubling down on oil growth and consolidation, particularly in the Permian, in this short cycle, quick payback area that has been favored in the last decade. And while the Europeans are really diversifying quite quickly away from oil towards gas and eventually electrons, and extending their portfolios across the electricity value chain to move from big oil towards big energy. And so as a direct result of this, we think that Europeans will almost certainly cede some market share in their upstream businesses over the next decade as they de-emphasize this oil exposure. They're curtailing exploration and deploying a lot more capital towards their green portfolios. And this is going to come at a cost of returns, given this historically lower margin businesses in renewable power. But it is important to note here that the two majors which are most exposed to renewable power at the moment, which is Total and Equinor, have significantly outperformed their European peers this year. And so if you look at this chart, the strategic divergence between these groups is no more apparent when you look at the emissions objectives for the companies. You can see that the Europeans have all included net zero on scope 1 and scope 2 and scope 3 as well, while Exxon and Chevron have declined to outline any overall absolute or intensity-based targets and are unlikely to do so in the future. So really to conclude, we see the European major strategies as ceding this near-term market share in oil in order to be much stronger and better positioned for the long-term diversified global energy system, while the Americans look to capitalize on a disruptive and disorderly energy transition over the short to medium term, in which they're capturing value from this falling supply, non-OPEC supply, which is mismatched with relatively resilient demand. So that's it for me. Now I'm going to hand it off to my colleague Grant. Thanks very much for listening.
So good morning, good afternoon, everyone. Thanks for that, Will. So I'm Grant Sporer. I'm a metals and mining analyst based here in London. And I'm just going to take you through our view on metal prices in particular. So if I could have the first slide, Roger. If we look at the price performance of the metal complex, my view is certainly that we are at the very mature phase of the recovery cycle. We're starting to see restocking behavior, unlike fuel here in the UK. It's definitely starting to cool. Demand outside of China remains very firm, but we're starting to see some serious cracks showing in China, where demand has cooled quite considerably. We're also starting to see supply, which is starting to normalize for most commodities after the COVID-19 disruptions that we had. There are some exceptions, and aluminium being the most notable one, and I'll come back to that, the aluminium. On the chart here, it's the blue line. It is the best performing base metal. The chart just shows the various metal price performances rebased to the beginning of 2020. But at this point of the metal cycle, it's the supply side shocks or the supply side dynamics that can really make for a strong performance differentiation. So you can see from the chart that some of the commodities have come off their peaks, certainly copper in the orange. Iron ore most specifically has come off the most, that's in the pink. And even European steel is just starting to show some signs of weakness. Now, our view is very much that some metals, like particularly ones that have a transformation component to them, like steel and aluminium, are probably going to settle out at a higher mid-cycle price than we've seen previously. And that's really due to ongoing trade barriers, some good supply management from the producers, but also the cost push pressures from decarbonization. But overall, for the most part, I think inflation due to metal prices has probably peaked and is likely to ease lower from here. If we could have the next slide, please, Roger. So look, turning specifically to aluminium, I mean, the metal is still moving upwards and has been hitting multi-decade highs. In part, that's due to China's so-called emission control, where they're clamping down on the heavy emitters ahead of the Winter Olympics in Beijing. But it's also, aluminium is one of the most energy intensive metals to make. So effectively, this is a power or a gas second derivative. So the tightness in the global energy markets is starting to feed through into aluminium. And on the chart here, we can see all the carbon-based commodities that we look at, certainly on a tear. just in here, the blue one is actually met coal, and I would cite that as a prime example of a combination of trade barriers. So we've seen China refusing to buy Australian coal, very limited new investment in the commodity due to the pressures of decarbonization. So you can, yeah, it's a very similar sort of theme that we've heard from both Will and Sully in terms of oil and some of the other carbon-based commodities. Just on to the next slide. I really just want to highlight the point on energy intensity. And here we can see that aluminium is certainly one of the most energy intensive metals to produce. It takes about 15,000 kilowatt hours to produce a ton of aluminium. Whereas if we look at copper on a relative basis, it's a lot less energy intensive. I'd also note, just as a small aside, that anything silicon based is also actually quite energy intensive. So the irony here is some of Rob's photovoltaic manufacturers are also seeing some energy cost push inflation doing in their production base due to the high cost of power. If I move to the next slide, so fundamentally, why do I think that metal prices inflation is peaking for now? So what I have here is really it's a China steel heat map, and although I've tried to capture specific drivers for steel, there is a lot of overlap with all of the metals. So we can see that the reading of August, and I know it's quite small, the readings are in the low, the aggregate or the composite reading is in the low 20s. And that's one of the weakest readings we've seen over the past few years. The previous low was during the height of the COVID crisis. And the peak was actually in April this year, down from 67. So we've really seen a sharp slowdown indeed. And China being 50% upwards of any commodity demand, I mean, it's really a demand slowdown story out of China that I think is going to put pressure on metal prices. So on this map, we've got credit, we've got PMIs, and we've got a lot of activity indicators. The weakest here is actually credit and the Chinese property market, and we've seen a lot of the fallout from the Evergrande potential default. So that's particularly if I can show you one picture of demand out of China, this would probably be it. If I can move to the next slide, I'm going to take a slight sidetrack on commodities as a hedge against inflation. And look, this trade hasn't really worked very well over the past decade if we look at it compared to a broad basket of commodities. So on the left-hand side, we've got the Bloomberg Commodity Index, and please note that these are total returns, and that's the way most investors would invest in these indices. The best subset has been the precious metals. That's the chart on the right. Again, total return. Not only the performance of gold over last year, but also a function of much less extreme yield roll than we sometimes get with the energy complex. And that's one of the reasons why precious metals actually perform when you invest in them through an index. Going forward, though, we think the industrial metal complex probably has a better chance of being an inflation beta over the medium term. And that's really to do with the decarbonization, which we see as a strong secular driver of demand going forward. Now, if I look more specifically at my European steel companies, and if I could have the next slide, please, Roger. Look, these companies are probably on the right side of the inflation equation for now. Many of them are actually negotiating contracts on an annual or quarterly basis, and these are probably going to be at a higher level than they were before, even though the spot market in steel is just starting to soften. We've also seen iron ore, which has fallen very sharply due to China's weakening demand and their push to control pollution. I would say, look, it's probably as good as it's been on a spot basis. So we're expecting some of the steel companies to have a really good couple of quarters of positive earnings momentum. But I guess it's hard to see that being sustained well into 2022, especially when we've got very weak auto sales in Europe, which is the second largest consumer of steel in Europe. So on the chart here, we show the profitability of a blast furnace-based producer in Europe. And we can actually just start to see the impact of the coking coal prices, which I mentioned earlier. That last dip was partly due to steel prices softening, but also very much the coking coal price, which is ratcheted up very highly. Now, just to point out, these guys, the steel guys, purchase on contract basis. So this is purely on a spot basis, but it gives one an indication of where profitability is likely to go. And to build on to something that Rob mentioned, just if I can go to my last slide, I wanted to point out that the impact of high carbon prices, and by carbon I mean carbon credits, gas prices, and indeed met coal prices, actually have the potential to accelerate the decarbonization trends we're starting to see in the steel sector. So even though green hydrogen today is actually quite expensive to produce, with the best cost of production probably being around $3.50 a kilogram, at today's carbon prices, it's actually now competitive to produce steel using hydrogen. And if I can just describe this slide here, on the left-hand side, we have a typical blast furnace, which uses spot coking coal prices as of today, which are quite high. The blue is actually what it costs today, and then the orange is actually the CO2 costs if there were no free allocations. Now, in many instances, the steel producers get up to two-thirds, sometimes even higher free allocations, but we expect those to diminish as the decade wears on. If we look at on the right-hand side, or the electric arc furnace, which is 50% based 50% scrap, and then 50% of directly reduced iron using natural gas, that's pretty much exactly the same price as we see as a blast furnace. And if we look at it, if we had to produce that steel using green hydrogen at a cost of $3.50 a kilogram, it's actually slightly cheaper. And with most producers sort of saying we need hydrogen at a price of $1 per kilogram, that's obviously would bring down the costs a lot, but that would put it in line with a blast furnace with coking coal at $150 a ton. So that's what we probably see over the medium term. But the point being is that green hydrogen today is at even at 350s is cheaper than using natural gas, or indeed a blast furnace, if you have to fully cost the CO2 carbon credits. And I've done this calculation at 60 euros a ton, not 65. The spot price has moved since I did this calculation. So very much seeing these carbon prices probably going to accelerate the trend of decarbonization. And today we saw ArcelorMittal make another announcement of a partnership with some of the in Belgium. On that note, I'm going to leave it there, and I think Roger's going to open it up for questions. So thanks very much.
Yes, well, thank you very much indeed. I've unlocked the mic, so if you'd like to ask a question, please raise your hand and we can just work our way through. To kick things off, maybe Rob and Grant, I'd be interested, at what point do the hedges roll off for carbon for your industries when producers are going to feel the full brunt of the higher carbon prices and the higher energy prices? Do you have a feel for that?
Bob, I'll just quickly say that it really does vary from company to company, but what I would say is that in the aggregate, there is a big bank of unused credits. So when the system was first designed, the cap was up here and emissions were down here. So every year, industry was actually building up excess credits that they could use in future years. And so right now, the system as a whole could emit 1 year's worth of emissions without having new supply coming in. So there is a lot of, I guess, stored up CO2 credits out there, and nobody really knows where they sit. But some of the companies do disclose some of their banked positions. I know RWE has a big German utility has quite a large bank on their balance sheet, and as Grant has noted, some of the steel producers do as well. So, but over time, that is going the cap is going to get much more binding, and I would say by mid-decade, you could probably think of that bank as not being as material or relevant.
Yeah, just to add on the steel producers in terms of their own, let's say, raw material inputs, there's probably a lag at the least of at the low end of a quarter, probably up to 6 months, maybe even slightly longer for some of the other producers. But just to echo what Rob has said, look, the steel producers have been quite cagey about how many sort of banked credits they have, and they have been buying ahead of their requirements. But yeah, I would agree with that. It's probably 2, maybe 3 years before, they really start to feel the squeeze from the spot market.
Well, thank you. Sally, one other question. Do you expect the OPEC discipline that we've seen to sustain as we look out over the next couple of years?
I think so. I mean, like I said, historically, when you look at the long history of them, compliance wasn't always so great. But since the accord that we had right after the pandemic, I mean, compliance has been very close to 100%, not just for OPEC, but for the wider group. So, and I think they are seeing the benefit of kind of giving the markets that that kind of credibility. So I don't see. I mean, we do highlight it as one of the potential downside risks for Brent, but I don't see why we would see compliance just fall off a cliff right away. But I think one thing to mention that we will be watching very closely is how we did see, especially Nigeria and Angola, really struggle to boost their output up to the new target levels every month. So if that continues, then that could kind of make up for potentially some lower compliance by some other members. So.
Okay, well, thank you very much. There don't appear to be any more additional questions at this time. So I'd like to thank our presenters for a fascinating hour, which they've delved in great detail into these great topics, and also you for your participation. We are here. You can, on any of the dashboards, BI Go, top left, hit action, and you can find out, you can directly IB or message any of the team with any of your questions. I will send out the slides later this afternoon, and we look forward to an active engagement going forward. That concludes today's event.